If I asked you what the fastest growing entertainment sector is right now, you'd probably guess, I don't know, something involving artificial intelligence.
Oh, for sure. Or, like virtual reality headsets, maybe.
Right, exactly. Or some new ultra premium tier of streaming video.
Yeah.
You probably wouldn't guess, well, you definitely wouldn't guess compact discs.
Yeah, nobody is guessing CDs in 2026.
Seriously. And if you looked at your investment portfolio right now, trying to find those hidden gems, you'd likely skip right over the companies that warehouse and ship physical plastic media.
Which is exactly what most of the market is doing.
But you'd be wrong on both counts. So welcome to the deep dive. Today we are cracking open the Q3 2026 earnings call for Alliance Entertainment Holding Corporation.
That's ticker symbol AENT for anyone following along at home.
Right. And we are applying our data-forward, plain language, and highly opinionated framework to a company that most of the financial world just assumes is an absolute dinosaur.
Yeah, Wall Street has this really stubborn habit of building linear models.
What do you mean by that exactly?
Well, the prevailing assumption is always that progress is a one-way street, right? The VCR gets replaced by the DVD player.
And the DVD player gets replaced by Netflix.
Exactly. It's clean, it's binary, and honestly, it makes financial forecasting incredibly easy for analysts. They just love to forecast the decline of an old medium and map it directly onto the rise of a new one.
Right, but human behavior, especially consumer behavior, is just rarely that neat.
No, not at all. It doesn't move in a straight line. It often moves in circles or, chaotic spirals. The things Wall Street has essentially left for dead, these so-called obsolete technologies, they aren't just surviving in weird niche corners.
I mean, in some cases, they are practically printing money.
Yes, literally.
And that is the exact premise we need to explore with you today. The death of physical media has been vastly, wildly exaggerated.
Vastly.
We're going to spend the next hour unpacking how a supposed legacy distributor of CDs and DVDs, a company that, casual observers might assume just got stuck in the late 1990s.
Like a Blockbuster holdout or something.
Exactly. How they are quietly transforming into a high-margin, tech-enabled platform for the booming fandom economy.
Yeah, because Wall Street looks at a company distributing plastic discs, and they slap what they call a dinosaur multiple on it.
Right. A dinosaur multiple, meaning they assume the business is going extinct, so they value the stock at just a dirt cheap price relative to its earnings.
Yep. But when you actually dig into the reality of Alliance Entertainment's recent quarter, the narrative completely flips.
Okay, let's unpack this. Before we can even begin to understand the cultural story of the company, pop culture shifts, the tech pivots, the nostalgia economy, we got to start with the raw data.
The numbers are the bedrock, always.
Right. They strip away the corporate marketing speak and tell us the unvarnished truth about what consumers are actually doing with their wallets.
So we are going to dive straight into the headline numbers from their fiscal third quarter, which ended March 31st, 2026.
We need to compare top-line revenue growth against bottom-line profitability, because that glaring contrast between those two metrics, that's where the real investment thesis for A&T begins to emerge.
Absolutely. So let's lay out the top-line revenue first, because there is a serious acceleration happening here.
Yeah, in Q3, Alliance Entertainment's net revenue hit $258 million.
Which is an impressive 21% year-over-year increase from the $213 million they did in the same quarter last year.
And look, 21% growth in a single quarter for a physical logistics business, that is massive.
Oh, it's huge. But to really understand why that number is shocking, you have to look at the longer timeline.
Right, the year-to-date numbers.
Yeah. For the 9-month year-to-date period, the revenue was $881 million. That year-to-date figure represents only a 5% increase over the prior year.
Wow. Okay, so 5% over 9 months, but 21% in the most recent 3 months.
What's fascinating here is the sheer velocity of that acceleration. That's what should make any retail investor sit up and pay attention.
Yeah, think about what those two numbers mean when you place them side by side. You have this massive distribution business that was tracking at a very modest, steady 5% growth rate for the first 2/3 of its year.
And a 5% growth rate is fine. It keeps the lights on. It outpaces baseline inflation, but it certainly isn't turning heads, right?
It's not triggering algorithmic buy signals on Wall Street, that's for sure.
Exactly. But then suddenly, in the third quarter, growth explodes from 5% to 21%. This shows a business that is catching a massive, undeniable tailwind late in its fiscal year.
Whatever strategic seeds management planted in Q1 and Q2 or whatever inventory they stockpiled, it's suddenly bearing fruit at a staggering pace.
Right. They hit the gas pedal hard in Q3. And a $45 million jump in quarterly revenue. That isn't just a rounding error.
No, that requires moving a tremendous amount of physical product. More trucks, more warehouse throughput, more retail partners clearing shelf space.
But as any seasoned investor knows, revenue is only half the story.
Right, because you can sell $1 billion of product and still go bankrupt if your costs outpace your sale.
Exactly. You have to look at profitability.
Yeah.
And this is where the Alliance transcript goes from just interesting to genuinely surprising.
Okay, let's look at how that explosive revenue translates to earnings per share, or EPS. Q3 net income increased 22% to $2.3 million.
Bringing their quarterly EPS to 5 cents, up from 4 cents a year ago.
But the year-to-date numbers, this is the crazy part. Year-to-date net income skyrocketed 78% to $16.6 million.
I mean, those numbers represent the absolute holy grail for a fundamental value investor.
78% net income growth.
Yeah. Net income growing at 70% over a 9-month period, while revenue only grew at 5% over that same period. That is a masterclass in business efficiency.
It tells us that the company is completely uncoupled from the linear relationship between sales and costs.
And their year-to-date adjusted EBITDA increased 47% to $35.7 million.
Okay, let's pause right there, because we just threw out some heavy financial jargon that we need to translate into plain language for you. First, let's talk about EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Right, which sounds like an accounting textbook. But think of EBITDA as the rawest, purest measure of the actual cash a business generates from its core operations.
Yeah, before the accountants and the tax man get in there and start moving numbers around on the balance sheet.
Exactly. So seeing their core cash generation jump 47% is a massive signal of underlying health.
But the real magic trick here is how a 5% increase in sales turns into a 78% increase in net income.
Right. That is a textbook example of operating leverage.
Operating leverage is basically the engine of wealth creation in logistics and distribution businesses.
Let me give you an analogy to make this crystal clear. Imagine you own a neighborhood coffee shop.
Okay, I'm with you.
You have fixed costs that you have to pay every single month, regardless of whether one customer walks in or 1,000.
Right, like rent.
Yeah, rent for the building, your barista's hourly salary, commercial insurance, electricity to keep the espresso machine hot, all of that.
Stuff you pay no matter what.
Exactly. Let's say, just to make the math easy, you need to sell exactly 100 cups of coffee a day just to break even on those fixed costs.
Okay.
Those first 100 cups. Your profit margin is essentially zero. Every single penny from those cups goes right out the back door to keep the business alive.
Right, you're just paying the bills.
But cup number 101, that cup is magical.
Because the rent is already paid.
Yes. The barista's already paid, the lights are already on.
Yeah.
So the profit from that 101st cup minus the tiny variable cost of a handful of beans and a cardboard cup goes almost entirely straight into your pocket.
That is operating leverage in action. And Alliance Entertainment is pouring that 101st cup of coffee millions of times over right now.
That's a great way to put it.
Because their fixed costs are massive but stable. They operate sprawling, highly automated warehouses. They have legacy logistics networks, corporate overhead, complex inventory management software.
And all that infrastructure has already been paid for by their baseline sales.
Exactly. So as they push higher volumes of premium products through that existing paid-for infrastructure, like we saw with that 21% revenue spike in Q3, the profits disproportionately flow down to the bottom line.
They aren't just selling more items, they're making significantly more money on every new dollar that comes through the door.
It is the fundamental difference between a business that's merely getting bigger and a business that's actually getting better and more efficient.
Okay, but as an investor looking at the whole picture, I have to stop and point out a wrinkle I found in the transcript.
Let's hear it.
If they are making so much more money on the bottom line, if they're pouring that highly profitable coffee, why did their gross margin percentage actually drop this quarter?
Ah, the margin nuance.
Yeah. I'm looking at the data, and the gross margin for Q3 slightly dipped to 12.8%, down from 13.6% in the previous year.
Right.
Normally, a shrinking gross margin sends retail investors running for the hills. It usually implies that a company's pricing power is weakening or that supply chain costs are spiking out of control. How are we reconciling a drop in gross margin with a 22% increase in Q3 net income?
It is the single most important question to ask about this quarter. And honestly, it's exactly the kind of nuance that algorithmic trading bots completely misinterpret.
Which creates an opportunity.
Exactly. It creates mispricing opportunities for human investors who actually take the time to read the transcript. The answer comes down to a structural retail concept called mix shift.
Mix shift. Okay, explain that.
Well, Alliance doesn't just sell one thing. They sell a massive, incredibly diverse variety of physical products. Some of those products, like highly limited exclusive vinyl records or premium 4K steelbook movies, have incredibly high profit margins.
Right.
Other products have much lower margins, but they drive massive volume and necessary foot traffic.
So what exactly were those lower margin products that dragged the percentage down in Q3?
Management explicitly explained that during Q3, while their premium collectible categories continued to grow, they also intentionally scaled up the distribution of some significantly lower margin categories to capture broader market volume.
Like what?
We are talking about standard consumer electronics accessories, basic audio cables, mass market discount DVDs destined for the bargain bins, and lower tier bulk pop culture merchandise.
So basically pallet fillers.
Exactly. They're essentially pallet fillers.
So they are using these items to grease the wheels of the entire logistics network.
Yes. They get the trucks full, they expand A&T's footprint inside the physical retail stores, and they capture raw market share. They accepted a lower margin percentage on these specific high-volume items in order to generate a massive influx of raw, absolute gross profit dollars.
It makes perfect sense when you look at how retail actually functions. It's exactly like a grocery store putting gallons of milk or cartons of eggs on sale at a razor-thin margin.
Or even taking a loss on them as a loss leader.
Right. Because they know those low-margin staples will get you in the door. And while you're there to buy the cheap milk, you're likely going to walk down the aisle and buy high-margin items like, I don't know, artisanal cheese, a bottle of wine, and organic produce.
Alliance is doing the same thing. They are feeding the lower-margin bulk electronics and discount media into the retail ecosystem to maintain their dominance as the primary distributor.
Knowing it pulls the high-margin collectibles along with it.
Right. And we know this strategy worked beautifully because the absolute dollar amount of gross profit still went up significantly.
Yeah, that's the key.
But more importantly, as an investor, you cannot get hyper-focused on the noise of a single 3-month window. You have to look at the 9-month trend.
Right, zooming out.
Year to date, their gross margin actually expanded by 170 basis points, rising to 13.3%. So the structural long-term trend of the business is upward margin expansion.
Okay, so Q3 just featured a slight, highly strategic dip in the percentage to grab volume and market share heading into the back half of the year.
Precisely.
All right, let's talk about the foundation of the house. The balance sheet. For anyone managing their own portfolio, looking at balance sheet health is crucial.
Especially right now.
Yeah, especially in a macroeconomic environment where interest rates are still relatively high and the cost of capital is punishing for companies that mismanage their cash. Let's look at Alliance Entertainment's liquidity position.
What are the numbers?
Right now, their working capital sits at $60 million, and they have $56 million in available liquidity on their credit lines.
Liquidity is the oxygen of any business. In the distribution industry, having $56 million available means Alliance is breathing very, very easily.
Right. It means they aren't living hand to mouth or relying on the next invoice clearing just to make payroll.
Exactly.
As an investor, the question you should be asking here is, what does this cash buffer actually allow them to do? The actionable takeaway is that Alliance Entertainment has the cold, hard capital to aggressively fund strategic initiatives that their smaller, cash-strapped competitors cannot afford.
Yeah, like securing exclusive distribution partnerships with major Hollywood studios. That offer requires significant upfront capital commitments or minimum guarantees. AT&T can just write those checks.
Or if there is a sudden supply chain hiccup, like a massive strike at the ports or spike in global freight costs, They have the cash to weather the storm without disrupting their service to retailers.
And crucially, for the retail shareholder, it means they can execute their growth strategy without needing to issue secondary dilutive stock that would immediately crush the value of the shares you already hold.
They don't have to go to the bond market and take on toxic, high-interest debt that would choke their future cash flows for years to come.
Exactly. They are operating from a fortified position of financial strength.
Which brings us to, honestly, the most fascinating part of this entire deep dive. The numbers we just went through, the 21% revenue spike, the 78% net income growth, the solid liquidity buffer, those numbers aren't magic.
No, they're just trailing indicators.
Right. They are just the mathematical exhaust fumes of human behavior. They are the trailing indicators of a fundamental shift in how consumers are choosing to spend their money and construct their identities.
To understand why revenue jumps so aggressively, we have to look at what consumers are doing in their living rooms.
We need to look at the story behind the numbers and the massive pivot from pure distribution to the collectibles market.
And management was remarkably blunt about this on the call. They explicitly noted a structural shift in their entire business model. They stated on the record to their investors that they no longer view themselves as being in the declining physical media business.
They are now in the collectibles business.
Right. And that is a profound psychological and strategic pivot for a legacy management team. They are fundamentally changing the definition of what it is they actually sell.
They aren't selling plastic discs that simply hold audio or video data. They are selling cultural artifacts.
Think about this from your own perspective as a consumer. Buying a compact disc today has absolutely nothing to do with needing access to the music.
Oh, obviously not. Spotify, Apple Music, YouTube, they all solve the access problem flawlessly.
Right. Instantly and practically for free, you have the entire recorded history of human audio available in your pocket at all times. So why buy the disc?
Because buying a CD today is about ownership and identity.
Exactly.
It's the difference between looking at a high-resolution picture of a vintage classic car on your smartphone and actually feeling the heavy metal keys to that car in your pocket. One is a fleeting, temporary digital experience.
And the other is a tangible piece of your identity that you can touch, display, and own.
Yeah. When you stream a song on a platform, you are merely renting a temporary micro license to hear it. The moment you stop paying your monthly subscription fee.
Or the moment the platform loses the licensing rights from the record label.
Right, that music vanishes from your library. The digital world is infinitely reproducible, which inherently means it possesses zero intrinsic scarcity.
But human beings, on a deep psychological level, are hardwired to value scarcity. We want to hold things, we want to display them in our homes, we want to be able to point to an object and say, this is mine, and this physical thing represents who I am and what I care about.
And the hard data on this vinyl and CD renaissance is absolutely mind-blowing. It completely shatters the mainstream narrative that physical music is dead.
Let's hear the transcript numbers.
Let's listen to this. Vinyl revenue increased 15% to $99 million in just this one quarter.
Wow.
Let that sink in. Nearly $100 million of heavy, fragile vinyl records shipped in 3 months. Over the previous fiscal year, 2025, they sold 16.8 million individual vinyl units.
I mean, the resurgence of vinyl has been a known, well-documented growth story in the financial press for over a decade now. It has evolved from a hipster niche into a mainstream retail category. But the true shocker on this specific earnings call, the data point that should make investors completely reevaluate this company, was the CD data.
The CD numbers are staggering. CD revenue grew an unbelievable 90% to $39 million in the quarter.
90% growth.
Yes. In 2025, they sold 13.5 million CDs. We're talking about a piece of technology that most of the tech world assumed died the day Steve Jobs announced the first iPod, and it is currently experiencing a hyper-growth renaissance.
It's wild. Even physical movie revenue, which has been brutalized by streaming, grew 5% to $61 million.
So, to understand why a supposedly dead format like the CD is growing at 90%, you really have to look at the broader cultural and retail landscape.
Look at the major big box retailers right now. Target is in the middle of fundamentally redesigning its massive store layouts to heavily expand its pop culture, vinyl, and collectibles aisles.
And GameStop is relying on physical collectibles as a massive pillar of its overall corporate survival strategy.
Exactly. What we are witnessing is a localized, tangible reaction to an increasingly ephemeral, purely digital world.
The more our daily lives, our work, and our social interactions move into the cloud, the more desperately we crave physical totems in our physical spaces.
It is the ultimate counterculture flex for younger generations right now.
Yeah, having a curated wall of CDs or a heavy milk crate full of vinyl is the new status symbol for music fans. It's an aesthetic choice.
Gen Z fans are discovering bands on TikTok or Spotify, but they aren't stopping there. They want the physical CD, complete with the liner notes, the album art, and the jewel case.
They want to put it on their shelf as a physical badge of honor. It signals a level of fandom that a Spotify playlist simply cannot convey.
And Alliance Entertainment isn't just riding this wave passively, they are actively engineering and shaping it. Let's look at a very specific, deeply revealing case study from the call.
Right. Record Store Day and their in-house brand, handmade by robots.
Record Store Day is a fascinating phenomena. It's an annual global event designed to celebrate the culture of the independently owned record store. And for Alliance, it is an incredible showcase of their logistical dominance.
First of all, Alliance shipped over 700,000 individual units to independent retailers just for this one event.
That number alone shows their massive, irreplaceable footprint.
If you were an independent record store owner in a mid-sized town, you simply cannot survive without Alliance. You rely on their warehousing and their trucking routes to stock your shelves for the single biggest make-or-break revenue day of your entire year.
They are the indispensable plumbing of the physical music industry.
But this year, they took it a massive step further. They didn't just distribute other people's music.
Right.
They launched a highly limited run of collectible figures under a brand they actually own outright called Handmade by Robots.
Specifically, they released an Ozzy Osbourne figure and a Hello Kitty figure. But the genius was in the supply chain management. They intentionally manufactured an artificially limited supply.
How limited?
They made exactly 2,000 units of each figure. The demand from the retailers was immediate and overwhelming. They received 6,000 orders for those 2,000 units almost instantly.
Okay, wait, let me stop you there. Putting on my skeptical investor hat for a second.
For it.
They sold out of 2,000 toys. At wholesale pricing, maybe 20 or 30 bucks a pop, we are talking about a few $100,000 in revenue, tops.
Right.
For a company that we just established is doing over $250 million a quarter, why are we even talking about this? Why did the executive team dedicate precious minutes of their earnings call to highlight a tiny run of Ozzy Osbourne toys?
That is the exact right question to ask, because the absolute dollar value of that specific toy drop is completely irrelevant to the thesis.
Okay, then what matters?
What matters is the proof of concept. The Handmade by Robots drop proves that Alliance Entertainment can successfully transition from being a low-margin middleman distributor into a high-margin owner and creator of in-house intellectual property.
Huh. So instead of just taking a tiny percentage cut for moving someone else's cardboard box from a warehouse in point A to a retail shelf in point B,
they actually own the box and everything inside it.
Right, because when you are operating purely as a distributor, your profit margins are constantly, relentlessly squeezed from both sides.
The manufacturers want to charge you more and the retailers want to pay you less. But when you own the brand, when you own the intellectual property like Handmade by Robots, you control the entire vertical value chain.
You control the artistic design, you dictate the absolute scarcity of the product, you set the wholesale pricing, and therefore you capture the vast majority of the profit margins.
Exactly. This small run of Ozzy and Hello Kitty figures is the blueprint for their entire future high-margin revenue strategy.
Right.
They are proving to Wall Street that they can manufacture and distribute cultural hits entirely in-house.
That represents a massive paradigm shift in how you value this stock. It turns them from a simple logistics and trucking company into a vertically integrated entertainment creation company.
And speaking of entertainment, we need to talk about the stabilization of the video market.
Oh, yeah. For the last 10 years, the DVD business has been the ultimate falling knife for investors.
Truly. Wall Street has just watched physical movie revenues bleed out quarter after quarter, year after year, as Netflix and Disney Plus took over the world.
But management noted on this call that this decade-long decline is finally bottoming out. The floor has been found, and the market is actually being supported by a 12% industry growth in premium 4K Ultra HD formats.
The physical video market is mirroring the music industry's evolution perfectly.
How so?
The casual, everyday viewer is perfectly happy streaming an incredibly compressed movie on a standard television. But the diehard cinephile, the home theater enthusiast, and the hardcore collector, they are actively rejecting streaming.
They are buying the premium 4K Ultra HD Steelbook editions of their favorite movies.
Because streaming compression heavily degrades picture quality and audio fidelity. The enthusiasts want the uncompressed pure data rate of a physical disc.
They want the director's commentary tracks, the behind-the-scenes documentaries, and the beautiful heavy metal packaging to display on their shelves.
Exactly. The physical movie market is absolutely shrinking in total mass market volume, but it is simultaneously concentrating into a highly profitable ultra-premium niche.
And Alliance has aggressively maneuvered to dominate that exact premium niche. Over the last year, they didn't just sit back. They secured massive, exclusive distribution licenses with absolute powerhouse Hollywood studios.
Specifically Paramount and Amazon MGM Studios.
This gives Alliance the exclusive distribution keys to some of the biggest cinematic franchises on the planet. For example, management specifically called out the upcoming physical release of the film Project Hail Mary, slated for August.
For context, Project Hail Mary is based on the wildly popular novel by Andy Weir, the same author who wrote The Martian. It is being positioned as a massive, blockbuster sci-fi event film starring Ryan Gosling.
So it has a built-in rabid fan base.
Exactly.
And Alliance expects this to be a massive needle mover for their Q4 DVD sales. Because they have the exclusive distribution rights, every single retailer in the country, from a massive big box store like Walmart down to specialized electronics stores, all the way to a niche local comic shop, has to go through Alliance to get this highly anticipated premium physical release.
Alliance is essentially the undisputed poll booth for premium physical media right now.
Which is a remarkably powerful, defensible position to hold in the market. But while mastering the logistics of the physical world is their foundation and their cash cow, the truly explosive upside for this stock lies in where they are heading next.
We've established how they got here by dominating the logistics of physical goods, securing exclusive studio rights, and leaning heavily into the fandom economy.
But management's forward-looking guidance reveals a strategic pivot that goes way beyond shipping boxes. They are aggressively pivoting into technology. Let's look at what the C-suite is telling us about the future, starting with their strategy for capturing the secondary resale market.
The secondary market, the massive, chaotic resale economy on platforms like eBay or at auction houses, is the holy grail for companies that make physical goods.
Right. Think about the economics of sports cards, vintage video games, rare vinyl, or limited edition comic books. The original manufacturer sells the item exactly one time for a fixed retail price.
But then that item might trade hands a dozen times over the next decade.
A rare comic book sold for $3 in the 1990s might sell for $3,000 today. Traditionally, the original manufacturer and the original distributor see exactly $0 from all of those incredibly lucrative secondary transactions.
They are entirely cut out of the appreciation of their own assets.
Enter Alliance Authentic and End State Authentic.
This is where the earnings transcript starts to sound like it's pulling concepts from a sci-fi novel, but they are executing it right now.
Yeah, management is launching a comprehensive strategy to encapsulate rare collectibles like limited Funko Pops, rare autographed CDs, and premium steelbook DVDs in tamper-proof, heavy-duty acrylic cases.
But the encapsulation isn't the genius part. The genius part is that they are embedding these cases with near-field communication, or NFC, chips for secure, immutable digital authentication.
For anyone not deep into tech hardware, NFC is the exact same underlying technology you use when you tap your smartphone to a terminal to pay for groceries with Apple Pay.
Or when you tap a hotel key card against the door lock.
Right. It allows a physical object to securely and wirelessly communicate a unique, encrypted digital signature directly to a smartphone perfectly every single time.
So let's go back to that record store day case study we discussed earlier with the toys. Of those 2,000 limited made, handmade by robots figures, Alliance took exactly 30 of them. 30 uncirculated, pristine, perfectly minted figures straight off the factory line, and they encapsulated them in these acrylic cases embedded with NFC chips.
The financial results of this test were astounding. While the standard unencapsulated figures were reselling on the secondary market on eBay for around $75.
The encapsulated NFC-chipped figures were actively reselling for $400 to $500.
An almost 700% premium just for the plastic case and the chip. Why the massive price discrepancy?
It all comes down to the two most valuable currencies in the high-end collectibles market: trust and provenance.
Yeah.
Counterfeiting is a massive multi-million-dollar plague on the collectibles industry. When you are about to drop $500 on a rare item online from a total stranger, how do you actually know it's real?
How do you know the box hasn't been carefully opened and resealed? How do you know the condition hasn't been altered?
Exactly. By encapsulating the item directly at the source, literally before it ever touches a consumer's hands, and embedding an unforgeable digital identity via NFC, Alliance is mathematically, cryptographically guaranteeing the item's authenticity and its pristine, uncirculated condition forever.
It's essentially building a Carfax for the collectibles industry.
Oh, that's a perfect analogy.
Yeah, when you buy a used car, you don't just trust the salesman.
Yeah.
You pull a Carfax report, which gives you the entire unalterable history of the vehicle. Every oil change, every accident, every previous owner.
It completely removes the anxiety and the asymmetry of information from the transaction.
Right. Alliance is using NFC tech to create a flawless, instantly verifiable digital Carfax for every single premium collectible they distribute.
And that Carfax analogy gets right to the heart of their new business model. We asked how a distributor makes money after the first sale. They do it by creating the digital standard for provenance.
If Alliance's authentication ecosystem, the chips, the app, the database, becomes the trusted gold standard for collectors, they position themselves to potentially take a cut of every future transaction.
Whether it's a microtransaction fee for transferring digital ownership, a licensing fee to auction houses to use their database, or simply by driving massive premium value on the initial sale, they are transforming a one-time physical transaction into a perpetual digital asset.
And the scale of this ambition is mind-boggling. On the call, they talked about expanding this exact NFC technology to the secondary market for vintage video games, to high-end audiophile vinyl, and eventually to the massive sports memorabilia market.
If they successfully own the digital infrastructure that authenticates the secondary market, they fundamentally stop being evaluated as a logistics company and start being evaluated as a high-margin tech platform.
And Wall Street pays massive, massive valuation multiples for scalable tech platforms compared to warehouse distributors.
That is the ultimate blue sky potential of this stock. It is a hidden, embedded option value that almost all of the traditional retail analysts are currently ignoring because they are too stubbornly focused on the fact that the company still ships physical DVDs.
But while we wait to see if that massive tech platform thesis plays out, we can't ignore the core distribution business because they have some absolute monsters in the pipeline.
We have to talk about the Q4 catalyst. Grand Theft Auto 6.
Oh, yeah. Management specifically highlighted the upcoming release of GTA 6 as a massive, transformative, future revenue driver for their gaming division.
For anyone who doesn't actively follow the video game industry, it is impossible to overstate the magnitude of Grand Theft Auto 6.
Yeah, it isn't just a video game release. It is a global macroeconomic event.
It really is. It has been well over a decade since the last installment, which generated over $8 billion in revenue. GTA 6 is widely expected by industry analysts to be the biggest, most lucrative entertainment launch in the history of human civilization,
dwarfing any movie premiere or album drop.
And Alliance is perfectly positioned right at the center of this cultural hurricane. They buy their physical video games directly from the publisher, Take-Two Interactive.
So when millions of gamers realize they absolutely must have the physical disc, either because the digital download size is too massive for their internet connection, or simply because they want the collector's edition box on their shelf.
Alliance is the entity responsible for moving those physical units to retail stores across the country.
But the real genius of Alliance's positioning isn't just shipping the game, it's the cross-sell strategy.
Break that down.
Alliance just secured a massive exclusive distribution deal. In November, just ahead of the game's cultural tidal wave, they are releasing an exclusive Grand Theft Auto compilation soundtrack on heavy vinyl.
And this isn't just some background orchestral score, right? It features over 20 massive A-list musical artists.
Exactly. So think about the actual sales motion happening on the ground level here.
Imagine an Alliance wholesale sales representative is on the phone with the owner of a local independent video game store.
Right. And that gaming store owner is calling Alliance in an absolute panic because they need to secure their allocation of GTA Age.
They need 50 physical copies guaranteed just to meet the rabid day one pre-order demand.
So the Alliance rep says, absolutely, we have your 50 copies secured, but by the way, while I have you on the line, you're going to have 50 incredibly hyped Grand Theft Auto fans walking into your small store on launch day.
I have an exclusive, highly limited edition vinyl soundtrack featuring massive pop stars that you can put right on the counter next to the cash register. Do you want 60 units of those too?
And the store owner says yes instantly because it's a no-brainer.
It is the exact same foot traffic, the exact same demographic, completely primed to spend money on that specific franchise.
Alliance perfectly leverages the immense gravitational pull of the video game release to sell a deeply high-margin vinyl record to the exact same end consumer.
It is a brilliant, highly efficient monetization of their existing distribution channels. They're taking a single cultural moment, the release of a video game, and extracting revenue from it across multiple distinct product categories.
Gaming, music, and likely soon, physical branded collectibles.
They are actively maximizing the revenue per square foot for all of their retail partners, which in turn cements Alliance as an absolutely indispensable partner.
The final piece of management guidance we need to cover before we render our verdict is their capital allocation and M&A, or mergers and acquisitions, strategy.
Yeah, management explicitly stated on the earnings call that they currently have multiple active non-disclosure agreements, or NDAs, out for potential acquisitions.
They told investors they are actively hunting for accretive, licensed product companies.
The word accretive is the critical keyword there. In Wall Street parlance, an accretive acquisition means that any company they buy must immediately, from day one, add to their earnings per share.
They are explicitly telling the market that they aren't looking for messy turnaround projects.
They aren't trying to buy struggling retail chains.
And they aren't throwing money at speculative, money-losing tech startups.
Right. They are looking for lean companies that already successfully manufacture profitable licensed physical products. Imagine a company that currently holds the license to make official Marvel, Star Wars, or anime figurines, but they only have a small regional distribution footprint.
Alliance can acquire that company, instantly plug those premium licensed products into their massive established global distribution network, and multiply the sales volume overnight.
It's a plug-and-play growth strategy that utilizes their massive cash reserves to buy immediate earnings growth.
So we've crunched the numbers.
We've unpacked the psychological shift from function to fandom collectibles. We've explored the massive logistics of Record Store Day, broken down the Carfax-style tech-enabled future with NFC chips, and analyzed the impending cultural tidal wave of GTA 6.
Now we owe you an opinionated, highly actionable conclusion.
So what does this all mean for you? If you're looking at your portfolio right now, are we fundamentally bullish or bearish on ANT?
To maintain objectivity as analysts, we must always start by rigorously defining the bear case. What are the tangible risks to monitor? What specific factors could break this investment thesis?
First, as we discussed in depth earlier, the drop in Q3 gross margin from 13.6% to 12.8% is a warning light.
It shows that in order to rapidly scale top-line revenue and maintain market dominance, Alliance still has to lean heavily on moving massive volumes of lower-margin pallet fillers in the short term.
If management mismanages that delicate mix, if they accidentally overorder low-margin electronics while premium collectibles stall that impressive top-line revenue growth, will fail to translate to the bottom line, and the operating leverage engine will sputter.
Second, we have to acknowledge their deep reliance on physical media fads. We have to be brutally honest. Consumer tastes, especially in the pop culture and aesthetic spaces, are notoriously fickle.
Right now, Gen Z loves the tactile aesthetic of vinyl and CDs. But what if that hipster nostalgia suddenly cools off?
If tomorrow the cultural winds shift and younger demographics decide that collecting heavy physical media is suddenly out of style, or they entirely migrate to some new, purely digital flex in the metaverse,
Alliance could be left holding a massive, devastating bag of illiquid, physically heavy inventory, taking up expensive space in their warehouses.
And third, the massive technological pivot into the secondary market requires immense behavioral adoption. Embedding NFC chips into toys and records is a brilliant, theoretically sound concept.
But it only generates value if the secondary market, the myriad of buyers and sellers on eBay, the specialized auction houses, the hardcore collectors actually trusts, adopts, and demands Alliance's specific authentication standard.
If a massive competitor builds a better, more user-friendly authentication system, or if collectors simply decide they don't care about a digital chip as long as the physical item looks good, that entire blue sky tech upside evaporates completely.
Those are real, highly tangible risks that any investor needs to weigh. But then you look at the bull case. The core thesis for aggressively buying this stock.
Wall Street currently looks at this company, sees the word DVD in their filings, and lazily prices it like a dinosaur slowly bleeding to death.
But the actual audited financial data, not the prevailing narrative, but the hard data shows a staggering 78% growth in year-to-date net income.
That level of growth isn't a statistical fluke. It is being actively driven by premium pricing power and intense, inelastic fandom.
People aren't buying CDs to access the data. They are buying them as luxury artifacts, and they have proven they will happily pay a premium for that ownership.
Furthermore, the company is solidly, comfortably cash flow positive. They have deeply entrenched structural partnerships with massive studios like Paramount and MGM and mega publishers like Take-Two.
Because of their $56 million in available liquidity and their disciplined tech-enabled inventory management, they hold virtually zero existential financial risk in the near term.
They aren't going bankrupt. They are actively hunting for acquisitions.
And finally, that NFC authentication platform, Alliance Authentic and Endstate Authentic, is essentially a free call option for investors buying in at the current valuation.
When you buy AET today, you are paying a very reasonable price for a highly profitable, growing physical logistics business. If the NFC tech platform completely fails to gain traction, you still own a deeply profitable logistics company trading at a discount.
But if the tech platform works, if they actually successfully become the trusted Carfax of the multi-billion-dollar secondary collectibles market,
it completely transforms their valuation multiple overnight.
They go from being priced by analysts like a slow-growth trucking and warehousing company to being priced like a high-margin SaaS technology platform. That represents a massive asymmetrical upside for the retail investor.
Therefore, weighing the immense cash generation and the embedded optionality against the manageable risks of consumer trends, the actionable verdict here is exceptionally clear.
We are taking a solidly bullish stance. For the retail investor, AT&T offers a truly unique, highly compelling blend. It is fundamentally a value stock, anchored by a cash-generating core logistics business, layered with immense, highly visible near-term catalysts.
Like the impending launch of GTA Z5 and the physical release of Project Hail Mary.
And it possesses a massive, long-term technology upside that the broader market is currently completely ignoring.
It is an incredibly rare combination of absolute safety and fundamental strength in the present, combined with explosive tech-driven potential in the future, all being steered by a management team that clearly deeply understands the psychology of modern consumerism and the mechanics of the fandom economy.
Let's bring this deep dive home by quickly recapping the three most important fundamental takeaways we want you to remember as you evaluate this stock. Number one, the astonishing 78% year-to-date net income growth.
Remember the coffee shop analogy. That massive profit spike is being entirely driven by operating leverage and the explosion in the CD and vinyl collectibles boom.
Number two, the profound structural transition of the entire company. They are successfully evolving from a low-margin middleman wholesaler into an IP-controlling, high-margin collectibles platform.
Anchored by their proprietary Carfax-style NFC authentication technology aimed at capturing the secondary resale market.
And number three, the massive, highly visible Q4 catalyst approaching like a cultural freight train in the form of Grand Theft Auto VI.
And Alliance's genius, highly efficient cross-selling of their exclusive compilation vinyl to ride that exact cultural wave at the retail level.
Those are the fundamental, unshakable pillars of the Alliance Entertainment investment thesis.
Absolutely.
To wrap things up, we want to leave you with a final, provocative thought. Something for you to mull over on your own that builds on everything we've unpacked today.
Think about how we started this conversation talking about Wall Street's stubborn assumption that progress is always a neat one-way street and that old tech is permanently dead tech.
We've just spent the last hour proving that physical media has fundamentally shifted from being a cheap, utilitarian method for accessing data into a premium status symbol driven entirely by scarcity, identity, and intense fandom.
So my question to you as an investor and as a consumer is this.
If CDs and vinyl can rise from the grave to become highly profitable luxury artifacts, what other supposedly dead, obsolete technologies sitting in a dusty box in your closet right now are quietly marinating, just waiting for the cultural winds to shift and become the next high-margin collectible?
It certainly makes you look at your old heavy Game Boys, your tangled wired headphones, and your bulky VHS tapes in a very different light.
Progress might just be a circle after all. Thanks for joining us on this deep dive. Keep digging into those incredibly dense corporate transcripts, look past the prevailing narratives, and we'll see you next time.